Well, good morning. My name is Phil Taylor. I'm the chair of the board of CFA Society New York, a position I'm very privileged to hold and greatly enjoy. If you are, I don't know how many people here are, actually let me ask for a show of hands just for fun. How many people here are CFA Society New York members? Okay, that's pretty good, about half. And how many are SQA members? Okay, good. It's pretty close to half and half. That's awesome. Well, we're very excited to be partnering with SQA on this event. It's kind of a momentous occasion to bring back these two great organizations. I very much encourage you to get more involved in either or both organizations. I'm thinking myself, I really need to join SQA now, so I should do that. And I believe we do actually have a reciprocal program where we offer discounts at each other's events. So even if you're not a member of both, you can still attend the events of the other organization. So that's kind of a nice benefit for all of us. This is part of our Artificial Intelligence and the Data Revolution series of events here at CFA Society New York. We've already had two incredibly successful and well-curated events on cryptocurrencies, which was last Tuesday, and on artificial intelligence, which was back in November. And both of those are actually available for replay on the web. I actually watched the AI one over the holiday, and it was very good for CFA Society New York members. And so if you have any other questions about membership, feel free to reach out to myself or Daniel. And if you are a member of CFA Society New York, Carol, who's in the back, can tell you all about the FinTech Thought Leadership Group, which leads the way in putting this series together and is doing a terrific job. It's my privilege to introduce our next speaker, Bryan Kelly. Bryan is Professor of Finance, I gather a new position, so congratulations, at the Yale School of Management, and is also Associate Director of their International Center of Finance. He's a research fellow at the National Bureau of Economic Research and a consultant at AQR Capital Management. His primary research fields are asset pricing and financial econometrics. He's interested in volatility, correlation, and tail risk in financial markets, banking sector systemic risk, financial intermediation, financial networks, and statistical methods for high-dimensional systems. His papers have been published in the American Economic Review, the Quarterly Journal of Economics, the Journal of Finance, the Journal of Financial Economics, and the Review of Financial Studies, among others, and I certainly couldn't have memorized that list. He's an associate editor at the Journal of Finance, the Journal of Business and Economic Statistics, and the Journal of Financial Econometrics. He's a two-time finalist and one-time winner of the AQR Insight Award, and is a winner of various other awards and research grants, including the Pharma DFA Prize for Best Asset Pricing Paper in the Journal of Financial Economics, the Jack Trainer Prize, the Roger F. Murray Award, and the JP Morgan Award for Best Paper on Financial Institutions and Markets. Before joining Yale, Bryan was a professor of finance at Chicago Booth, and he was educated at University of Chicago and University of San Diego, and holds a PhD in finance from NYU's Stern School of Business, and also worked in investment banking at Morgan Stanley. So please join me in welcoming Bryan Kelly.
All right, thanks a lot for the opportunity to be here and meet all of you. Thanks, for inviting me to present this paper. So a little bit of background on myself. My background is really at the intersection of asset pricing, empirical asset pricing, and econometrics. And this is how I got into thinking about text as data. And it's how I got into thinking about machine learning more broadly. So the paper that I was invited to present is a survey article that I wrote for the Journal of Economic Literature with two of my old colleagues at Chicago Booth. All of us are now gone. Matt Genskow, who's now at Stanford, and Matt Taddy, who's at Microsoft Research. So let me get started with a little bit of background on text mining. So I'm going to go way back here. I'm going to go back and talk about Depression-era text mining. So there's this guy. He's kind of a famous, one of the original econometricians. His name's Alfred Coles. So he was coincidentally also at Yale. This is where the Coles Foundation is. He was at University of Chicago as well. So he was doing kind of the early research and trying to think about what are some drivers of stock market fluctuations, and are any of these things predictable? So he asked the question, can professional stock market forecasters actually forecast market returns? And this was the empirical approach that he took. It's going to sound very familiar for anybody that's thought about forecasting markets using text data. So what he did was, he said, I'm going to look at this guy, Peter Hamilton's track record. All right, Peter Hamilton was the editor of the Wall Street Journal for about 30 years in the early 1900s. He was a well-known stock market prognosticator. He wrote a book called The Stock Market Barometer that was one of these predecessors of sort of the Graham and Dodd type of way of thinking about the world. All right, so he was well known for doing this. Every 2 or 3 times per week, he would write an article, an op-ed that was talking about sort of where he thought the market was going to go. All right, so this is what Cowles did. He said, I'm going to read all of these articles from 30 years of the Wall Street Journal. Every time I read one of these articles, I'm going to essentially assign a score to it. Is it bullish? Is it bearish? Or is it sort of uncertain? All right, very simple kind of manual classification approach. All right, based on that, I'm going to put together a trading strategy. I'm going to back test Hamilton's performance. And when he did that, the result was not so great for a well-known stock market prognosticator. So what he found was that if you just took a passive investment in the Dow Jones Industrial Average, you would have outperformed Hamilton's prognostications by 3.5% annualized. All right? So early textual analysis suggests that the text that was reflecting people's views of the market at the time wasn't so useful for stock market prediction. All right, so I want to fast forward and now start to relate that to what sort of modern day financial market and textual analysis looks like. Let me also say that for this paper really was designed to reach a broader sort of social science audience. I'll talk about some finance applications towards the end a little bit, but for the most part, you should think about this as, you know, our overview of what's happening in social science textual analysis. All right, so fast forward to today. We have a much harder problem on our hands than Coles did when he originally did this analysis, right? Because there are just so many more things for us to be reading, right? It's not something that you can manually do. You have to automate the task, all right? So this is, you know, a cartoon to sort of reflect what it is that's happening. We have all types of information, too much for us to handle manually. We have to put it into a machine in one way or another. So we're going to take all of this information, put it in the machine, spit out forecasts, and try and figure out whether or not we can isolate the informative content that'll make those forecasts actually usable, valuable. All right. That machine, though, is very much the same approach that Coles was originally doing. Okay? So if we want to think about the basic essence, the spirit of what the problem looks like, it is the same as the Depression-era text mining problem that Coles was trying to solve. Right? What we have now are just more realistic features of the world that make the problem hard to implement. So implementation, you know, that's a barrier, but it's the type of thing that technology is good for getting us over. All right, so I'm going to talk to you today about some of the things that we use to try and leap over those types of implementation barriers. All right, so rather than, for example, just manually reading and subjectively categorizing each article, we'll try and make text data, wherever we're getting it from, into something numerical. In order for us to do our statistical analysis, we have to have numerical data to work off of. We obviously can't just work off of the raw text. And then we're going to basically figure out how we can assign value, forecasting value, to this tokenized or this numerical textual data for a productive forecasting outcome. All right, so I'll proceed. I'll give you a little bit of background on what the problem looks like. I'll spend some time with the basic idea of how do I actually take a body of text and represent it as numerical data that we can then statistically analyze. And then I'll go through a couple of sort of think of it as like the primary tools that people are using in social sciences to analyze text. I'll refer to some of the more complicated tools that people are using outside of social sciences to analyze text. Maybe some of these tools will be things that you're more familiar with in your day-to-day. And then I'll go through one particular application at the end. All right, so in terms of background, we just have a lot more data at our disposal to work with on a day-to-day basis. So to give you a little sense of magnitude, The past 2 years alone, all of the data that's in existence, it was produced in those past 2 years. Which is to say that, over the entire course of recorded humanity, we gathered a lot of data, but we actually gathered more data in the past year compared to that entire history. All right. So this is an interesting thing. There's this from Domo that puts together a measure every year. How much data are we actually producing on a minute-by-minute basis? And this is what it looks like for 2017. Okay, the amount of data that we're dealing with is absolutely fascinating. All right, so I'm going to just highlight from this graph a couple of text data sets. So for example, Twitter, every minute, 500,000 tweets are sent out. All right. Let's talk about, for example, text. Every minute, 15 million texts are sent, 3.6 million Google searches, 600 modifications of Wikipedia pages, and the list goes on and on. There's an enormous amount of data out there that's being produced, being recorded, and is usable for forecasting problems. The question is, how do we actually bring all of that new information into problems that we're interested in? All across kind of the spectrum of the sciences. Here we'll be particularly interested in finance, and in our article we're interested in social sciences more generally, and I include finance in that broader classification. So long story short, we are recording a massive amount of things that we think are meaningful for understanding how the world works. What do human interactions look like? What types of information is being communicated? What is culture looking like? We have much more actually concrete, usable information now than we ever have before. All right. So I'd like to think about this information as being a very rich complement to the types of traditional data sets that we've worked with. So Professor Dar, he talked about using past price information, St. Louis Fed, numerical data about macroeconomic fluctuations as potentially useful inputs to forecasting stock prices or other asset prices, right? Now we should think about this other body of data as being different from what we've had before. Those are very structured types of data, but we have other unstructured data sources we can use. We have videos we can look at. We have images we can look at. And then we have text that we can use as well. I'll specialize here talking about textual analysis for these types of predictive problems. But really, you should be thinking about this as one example of unstructured information that we could bring to bear on forecasting. All right. Because of the development of the technologies that allow us to record all of this human behavior, there's, of course, now an explosion in research trying to analyze this. So this is an explosion in the methods that people are developing faster than we've ever seen before, and it's an explosion in the types of problems that people are now applying these methods to. So it's a very exciting time in the social sciences, thanks to advent of technology. So if you've not thought about a textual analysis problem from a statistical perspective before, the right place to start is just to think about the question of how do I think about this as being representable as data that I could actually use in a statistical procedure. So I'll be talking about representing text as numbers for a while. So if we want to do statistical analysis, we have to have some sort of numeric values that we could work with. All right, but this is not what humans do when they read text. Right? When they read text, they don't see the matrix. They see a much richer object than just the words represented in some numerical form. They draw a lot of information from the text as a whole. So that means there's going to be all kinds of interactions, for example, among the words that you would want to assign some numerical value. All these cross interactions from the words that show up in different places of the text that actually convey a lot of semantic meaning. Right? Ideally, we'd love to capture all of that semantic meaning. The fact that I use word A here and word B 10 words later might tell me a lot as a reader, as an experienced interpreter of texts, but it's going to be something that we're going to have to figure out how to bring into a numerical procedure, because that's not going to be necessarily the most obvious numerical quantity to actually write down and bring to our statistical model. All right, so computational linguistics has spent a lot of time and made huge progress actually trying to capture some of these deeper semantic meanings that show up in text corpora, right? So this is going to be different than the type of forecasting problem that we'll be thinking about in financial markets. For example, we have it really is essentially a prediction problem. When you talk to your phone interprets your voice and then tries to come up with its best replication of what it is that you're trying to say. That's a forecasting problem, and that's one of these forecasting problems that in the first talk today has a high signal-to-noise ratio. So statistical analyses are going to be sort of well-suited to solve this type of problem. When we move to finance, we're in an inherently low signal-to-noise ratio type of setting. All right. So one thing I'd add to the first talk that we heard this morning about where sort of finance and market prediction lands on the spectrum of ease of prediction and error costs is that there's a feedback mechanism that always pushes down the signal-to-noise ratio. It's the efficient markets effect. The more predictability you find, right, the more you take away that predictability, right? That's the idea that inherently we shouldn't expect there to be a lot of predictability in asset prices, because once we discover it, it should get baked into prices ex ante, and it should eliminate that forecastability, right? That's sort of the fundamental theorem of efficient markets, which means that if you want to apply these machine learning types of problems to financial settings, you're sort of always fighting this uphill battle. Once you find something that does look like a good predictor, it's not going to be a very good predictor for long, right? So finance is inherently a setting where you have the outside world reinforcing a low signal-to-noise set of circumstances. All right, so let's go back to this complex issue of trying to take all of the semantic content that a human reader would pull from a body of text and ask what we're going to do when we try and do statistical analysis of that text, numerical analysis of that text. And the fact of the matter is, all of that semantic content, well, we're not going to be able to retain too much of it. The fact of the matter is, if I try and retain too much of the cross dependence among words that show up in different parts of the text, I will end up with such a high dimensional problem that it will be infeasible for any realistic statistical problem. All right, so let me just say up front, in the social sciences, when they're doing textual analysis, unlike in some computational linguistic settings, in the social sciences, really we are going to throw away a vast amount of the meaning in the text just to make the problem feasible. Right? And I'll give you some examples of how we do that as we go. So what is it that's different about text? The first, and I think the most important way that text is different than traditional structured data that we're used to working with is that it's inherently super high dimensional. That's a technical term. Okay. So let's think about how high dimensional this problem is. So I have a sample of documents. I'll be thinking about tweets for a second to make it concrete. So let's say I have each document has W words in it. And of all of the words that I could put into my tweet, let's say that I'm drawing from an entire dictionary, an entire list of words that's P words long. All right. So the unique representation of any potential document that I could generate that has an article of length W, drawing from a vocabulary of length P, is P to the W. All right, so let's put numbers to that to get a sense of how big this is. Tweets, 30-word tweets. And let's say that my data set consists of 1,000 of those. If I wanted to think about the unique representation of that, the representation that could potentially preserve all the dependencies among the words, the unique representation of that has dimension roughly on the order of magnitude of the number of atoms in the universe. Right. So that's going to be a hard statistical problem to start to work with. That's a difficult setting to apply statistics in. There's an immediate consequence of what we do in this situation. It means that we're not going to be able to do the type of things that we've done, in your intro stats class, or even in kind of, your first or second year PhD stats class. We're not going to be able to run regressions and do maximum likelihood and things like this. We're going to have to turn to forecasting settings that are potentially capable of handling very high dimensional data. So that means we're going to end up working with a lot of tools that we work with in other machine learning domains. Right? So textual analysis, you should think of largely as being a subfield of machine learning. Even then, even the most sophisticated, most cutting edge, high dimensional settings, the tools that you would apply to a predictor problem where you have maybe thousands of forecast variables and you're trying to forecast the stock market return, even then those tools are going to start to break down if you want to retain the dimensionality of, say, those tweets that I just referenced, right? So what do we do to get past this problem and actually make the body of text analyzable in some way? Before we can do anything, even before we can bring it to these high-dimensional statistical analyses, we have to cut down the data in some way. This is where we're going to lose a lot of that semantic content that I've been referring to. So I'll go through some examples of the types of dimension reduction that people apply in these data sets. The exact dimension reductions you would do are very context-specific, but here are some common things that people like to do. The first thing is that we're going to throw out all of the sort of ordering of the words. So instead what I'll do is I'll just say, did a word appear or didn't it appear? That's going to be sort of one input to my data. I might extend that a little bit to think about, did particular phrases appear? How often did they appear? But what I'm not going to do is going to say, did word A appear 3 spaces before word B, or 5 spaces before word B, etc., and keep track of all of that structure. I'll also filter out a lot of words that are very common or very uncommon, right? So if you think about, typical things like articles, they don't carry a whole lot of semantic meaning, but they show up everywhere. So there's already kind of an immediate gain to the dimensionality that you can work with, right? Just by throwing out words that you can sort of ex ante take a guess might not be informative for the forecasting problem you have in mind. And this ends up being true for words that show up very infrequently as well, right? So supercalifragilistic is going to show up once in a while in the history of human communication, but it's going to be so infrequent that there's no way it could plausibly forecast anything, right? There are so many words. I'll show you the kind of the dimensionality that's associated with words that show up very rarely. It ends up being, again, we're kind of thinking about a trade-off here. Am I willing to throw away a lot of the semantic content at the benefit of making the problem maybe feasible or just easier to work with, more efficient, et cetera? So a lot of times the types of trade-offs that we're going to be willing to make is to get rid of very infrequent words that make my vocabulary much bigger but aren't going to give me a whole lot of bang in terms of forecasting. And then so this is a data processing approach that a lot of people use called stemming, which is to say there are a lot of variants on sort of the same basic idea. So here I gave one example of the word run. It shows up as runs, runner, running, etc. They have very different meanings, right? To a sophisticated user of text, this is going to convey different meaning. The question is how much different meaning, and are those differences in meaning sufficient enough for me to want to keep them in my algorithm, make my statistical analysis much more complicated? So one thing that's common is that we'll just stem these things. We'll retain the stem, we'll throw out all the suffixes, and with that, we'll throw out some semantic content. Do we feel good about throwing that out? No, we know it has some information, but again, it's kind of the feasibility versus detailed semantic content trade-off. Oftentimes, we'll do things like drop numbers, drop punctuation, drop proper names. Again, these are context-specific choices, but you see them used a lot in the social science literature. All right. The idea is we've got to boil down the problem to something that's more feasible, but we want to make sure we retain the information that's most diagnostic of what the document is actually about. All right? If I can just keep words and count how many times words appear, for example, maybe that's enough to tell me whether or not there's a forecast that the Fed is going to raise rates going forward. All right? It's ultimately an empirical question, and this is the type of tuning that we always have to wrestle with when we're doing any sort of machine learning type of analysis. All right, so let me give you just a walkthrough for people that haven't used text data for statistical analysis before, how you would actually go from a body of text to building up some numerical matrices that you could use for analysis. So the simplest form that this comes in is what's called bag of words. So I'm going to take a particular document. Here I'm going to look at the snippet from Romeo and Juliet. Good night, parting is such sweet sorrow. And I'm just going to count how frequently each word appears. So for good and night, these words each show up twice here. Part, sweet, and sorrow, these each show up once. I'm throwing away some very common words like is. And then all other words that exist in the English dictionary are just assigned a value of 0. So that's now my numerical representation of this document. Note that it ignores the order of words altogether. I didn't have to do that. I could have represented this as a bigger matrix, where I actually had things like indicator variables for whether or not a word shows up in a particular location. But that's exactly where that massive expansion in dimensionality comes from and would make the problem much harder to work with statistically. All right, so what do we lose when we do this? Here is the bag of words representation of Walt Whitman's Leaves of Grass. All right, it is exactly this numerical representation that I'm talking about, except instead of writing the list of all the words that show up in Leaves of Grass and the number of times each word shows up, I've just made the word proportional to its count in that document. So you look at this and it doesn't really convey the same thing that Leaves of Grass does, right? So we've lost something here. But the question is what we've kept good enough for the forecasting problem that we have in mind? All right. Now, these word count type approaches, these bag of word approaches, they can be extended, right? So if, for example, I want to retain some dependence but not all dependence among words, I could do things like use n-grams, for example. So I'll take all pairs of words that show up adjacent to each other, and I'll treat that as a new term. So for example, a new term here would be good night. I just count how often good night shows up and how often night parting shows up. And I would add those as essentially new counts in my database. I'd treat them as though they are new terms, new words that I have to work with. Right? And we could do more. We could do 3 grams, 4 grams, 5 grams, skip grams. We could look at every other word, so I'd have good show up here, for example. All right. We'll see in a minute how even a small choice like moving from unigrams to bigrams greatly expands the dimension of the problem that you have to work with. Right? So trying to add a little bit of the dependence among words, again, it just forces you to deal with an explosion in the number of predictors you're dealing with. All right. So once I sort of think about this bag of words representation of a document, I want to think about now building this into a bigger matrix that shows me all of the term counts for all of the documents that I might be studying. So the example that I want to talk to you about, and this is an example that I've been using in my research quite a bit, is to look at text from the Wall Street Journal. All right, so when you build a document term matrix, in one dimension, you have what you're defining as a document. On another dimension, you have what you're defining as the vocabulary of your document. So I might have 1 million words corresponding to the columns of my document term matrix. And I might have 500,000 articles. Those could be the rows of my document term matrix. But you, as the econometrician or the analyst here, has a choice about how you actually represent your data. So I'm going to be interested in a time series problem when I actually use the Wall Street Journal. So I'm actually going to build my definition of a document a little bit differently. Instead of defining a document as a specific article, I'm going to pool all articles on a given day. I'm going to call the Wall Street Journal on a given day a document. That's going to be useful for my time series analysis because now documents have the interpretation of a point in time. So what I do is I go through all of the articles on a given day, I pull them together, and I count frequencies of all the words in the vocabulary. So for example, on June 1st, 2017, Brexit showed up twice in the whole Wall Street Journal. DNA showed up 17 times. White House was absent that day. Chinese companies showed up 5 times that day. All right. So you look at this and you say, all right, how is this different than the type of data that I typically work with? How is it the same? It's very similar to the types of data that we'd be using in a forecasting problem before. Just call this data matrix X. Each column is a different predictor. I'm very used to working in settings where I have like 3 or 4 predictor variables to forecast some Y. So I have a 3-dimensional data matrix X, and I have a time series of it. I can do things like use that in regression. The fundamental structure of the data is not different here. I have a time series of predictors. The predictor variables are actually words. And then the values associated with them is just how often those words show up on a daily basis. The question is going to be then, can I use the time series fluctuations in those words, in those word counts, productively in a forecasting exercise? Can I use their joint variation, right? Okay, so that's where we're going. But of course, we're going to have to step outside the OLS setting because I'm going to have roughly 1 million words in my dictionary, so I can't run any sort of forecasting regression with 1 million regressors. Okay. Another thing that I want you to keep in mind, we're going to get to this in a second, is that when you look at this document term matrix, there's another way that it looks different from a lot of the data that you typically use in your forecasting problem. There are a lot of zeros here. All right. So the other way that text differs from traditional data is that text is inherently sparse. Most words show up very infrequently. A small number of words show up extremely frequently. We have to use statistical methods that are well suited to handle that kind of data. So let me just give you a little bit of a description of what the actual word counts end up looking like. So if you do word counts, so you treat all individual words in the English language as sort of the baseline variables that you have counts for, and you look at the distribution of those counts, you see that it follows something called Zipf's law. It's a power law. It's a very heavy-tailed distribution. These things show up all over in nature. For example, a couple of cities have all of the population in it, really. Okay? A couple of firms make almost everything that shows up in the economy. And a couple of words are used to describe all of the news that happens in the world. All right. So I can give you some specific quantifications of what I mean by this. So for example, in my Wall Street Journal data, I have 927,000, basically 1 million unique words. Of those, more than 75% show up with a count of lower than 10 over the entire 1979 to 2017 history. Right? These are words like super, fragilistic. Right? They just are not showing up, but they're in there sometime, so I'm keeping track of them. We might want to think about whether or not we should even have them in there at all. It would massively reduce the dimension of my system if I could get rid of, for example, those 750,000 words that just don't show up very often. Of course, if I were to get rid of those, I'd be running a risk. Maybe the one time I see the bigram nuclear bomb, it has really strong predictive power for something that I care about, like market volatility. Right? So this is the type of question that you have to make a choice on as the researcher. All right, I said if you add bigrams, you greatly expand the space of predictor variables that you have to deal with. So if instead of just looking at unigrams, so single words, I look at bigrams, I've now basically expanded my data set to have 3 million words. Again, making my prediction problem even harder to work with. And now we see that even more of those, of course, bigrams are going to show up much less frequently than individual words. So there are only 100,000 bigrams that actually show up more than 10 times in the Wall Street Journal. You can also ask, if I wanted to recreate the Wall Street Journal with like some margin of error, some tracking error, how many words would I actually need? So if I just use 208 words, I could rebuild 50% of the Wall Street Journal. If I just use 6,000 words, I could rebuild 90% of the Wall Street Journal. With 77,000 words, I could build effectively all of the Wall Street Journal, right? 77,000 is much smaller than the total size of the dictionary that I'm dealing with here. So most words show up very infrequently. A small number of words carry essentially all of the content that we're talking about in the data. All right, so most words show up with 0 counts most of the time, and we need statistical tools to be able to deal with that. All right, so let me spend a little bit of time that I have remaining to talk about some statistical methods. I'm going to do this pretty briefly. So I would talk about kind of the bread and butter toolkit as including a modified version of regression that's explicitly designed to handle very high dimensional prediction problems. And I'll talk to you about generative models, which are effectively ways to write down how the data is drawn. Think about it as a probability structure. And these can be sort of more specifically designed to handle the types of count data that you see in text. All right, there are also, like I said at the outset, much more sophisticated approaches to handling statistical analysis of text that I'm not going to touch on here. We talk about it quite a bit in our paper. For example, there's been allusion to deep learning and neural nets in the discussions you've seen already. You can apply these tools very profitably to textual analysis as well. They're much more complicated than some of the examples that I'm going to go through here, but I'll refer you to the paper for more detail. So let me talk about one example, regressing onto text. So suppose I want to do a forecasting problem. This would be, in this example, a contemporaneous forecasting problem. I want to understand, this is a deep economic question, what drives fluctuations in market volatility? All right. Now we go back and we think about the data that we have at our disposal now. we have data that in some sense is much more interpretable than all the data that we've used in the past to address this problem. Let's say before, if I wanted to forecast volatility, I'd go to the Fred database and I'd use a bunch of macroeconomic time series. So I run some regressions and I find some variables are significant, right? But those are all just a bunch of variables that are essentially jointly driven by some underlying fundamental economic processes. And I can't draw a whole lot of interpretation from regressing number data onto number data. Here, if I'm trying to forecast, say, volatility with text, my predictor variables are words. There's a fundamental interpretability built in there. If I find that, columns 1, 9, 500, 1000 are the good predictive columns, then I just look at what words those are associated with. And now my regression has a meaning built into it. This is the promise of text. This is the beauty of being able to work with this data. So suppose I run my regression. I'm trying to explain what happens to S&P 500 volatility using these word counts. How often does the word bubble show up? How often does the bigram Fed Titan show up? How often does the word terrorism show up? But of course, I have a million regressors here, so it's going to be a complicated problem. If I just tried to use OLS, and I try and do this regression of my target here, the S&P 500, on this big data matrix X, I have to estimate a million coefficients, right? We just don't have a chance. In fact, we couldn't even do this estimation. It's ill-conditioned. So instead of using OLS, we'll use penalized regression, which is we'll take the OLS objective function, which is to minimize the size of the squared errors that we put together in this forecast. We're going to try and find the parameters that minimize squared forecast error, but we're going to penalize ourselves for having non-zero coefficients, right? So what this effectively does is it forces me to shrink my coefficients. I'm going to sort of be working off of the prior that a lot of these coefficients are zero. I'm going to try and push my estimates of those coefficients towards zero. It's going to impose an inherent sparsity in the number of words that show up as meaningful predictors. It's effectively a variable selection technique. It's going to allow me to pull out the fluctuation in word counts that are most predictive, have the best diagnostic ability, the best explanatory power for where fluctuations in volatility come from. And now there's a tuning parameter. So in this equation here, it's this lambda. And I can play with that, right? I can do things like jack up the tuning parameter, penalize the hell out of the regression, and force the number of words that show up with non-zero loadings to be very low. All right. Okay. So this is kind of the most basic textual analysis one could think about. You build a document term matrix, and you do penalized regression on it. And if you look at the social science literature, this is sort of where a lot of the textual analysis is at in terms of sophistication. All right. Talk briefly about generative models. So a generative model differs from a regression type of approach in that it's going to write down a data generating process for where you think the text comes from. And then we're going to use the data that we observe to infer what that data generating process looks like. All right, so there are a couple of advantages of this. First of all, it's very well suited to handle high dimensionality. So if you have a million different things whose fluctuations you're trying to describe, a million different words, for example, whose fluctuations you're trying to describe, well, one common way, almost as old as regression in statistics, is the idea to think of it as sort of random effects. These things don't really all need their own parameters. They just need to be sort of drawn from some distributions that behave similarly across the variables that we're realizing. So that will help us do things like reduce the dimensionality of the problem, use a big matrix of a million variables in their time series, but in the end only estimate, let's say a couple hundred or a couple thousand parameters. And on top of that, these methods allow us to handle the data sparsity problem, the fact that we see a prevalence of zeros, right? So if I'm talking about word counts, they're count data. They're not continuous variables, right? Well, we have distributions that generate count data. We can think about things like multinomial distributions and Poisson distributions, Hurdle-Poisson distributions, which basically, reading the news and thinking about the bigram border wall, A hurdle Poisson is going to assign things to 0 unless some conditioning event happens, like Donald Trump gets elected president. Then I enter into the part of the Poisson distribution where those have non-zero values. Okay. All right, so I'm going to go through in a little bit more detail one particular example of a generative model, something that's called a topic model or latent Dirichlet allocation, LDA. So if you've done anything in terms of doing some sort of textual analysis with generative models, you're probably introduced to LDA, sort of like the entry-level generative model for studying text. And what this does is it effectively thinks of documents as just being randomly drawn from a bunch of urns. These urns are distributions over some notion of topics that exist in the news, let's say. And then the topics themselves are further distributions over all the words that can happen. So I'll describe exactly what I mean by that now. All right, so let's say that my goal here is to write a Wall Street Journal article. This is how you would do it from the perspective of the topic model. I sit down at my desk, I look out at the world, and I think that, okay, there are 50 topics that exist in the world. And they're not all equally likely. For example, here, topic 3, I've represented as bigger. It's the Fed topic. It has more likelihood of being sort of an important economic topic. Asia's here as well. This is a smaller topic in this data set. Tech is here as well. It's sort of a middle-sized topic in terms of its likelihood of being drawn. All right. Within each of these topics, they're going to tell me how likely words are going to be drawn related to those topics. So let's say that I'm trying to figure out what is the first word in my article, so I draw a topic from this urn. It comes out as the Fed topic. Not surprising, it was the most likely one. There was a good chance that I was going to pull it. So I pull the Fed topic and I look inside the Fed topic, and what that actually is just another distribution. Now it's a distribution over all the words. You should think of it as sort of a word cluster. Conditional on being in the Fed topic, what are the words that are most likely to be drawn? Well, here are some examples like Bernanke, inflation, reserves, rate hike, etc. These are the more probabilistic words. So from within this urn, it's a compound urn, right? So I pull from the internal urn and I get a word out. I pulled Bernanke. That's the first word of my document. Now I move to my second word. I start over. I go back to my urn. There's a good chance I pull the Fed again because it's a high probability topic, but in this case, I actually pulled topic 4, energy. Energy has its own distribution over all the possible words that I could draw. It's its own cluster of words. They're more energy-specific words, and I draw a word from that particular urn. It's oil. And I do this over and over again until I've built an article of the length that I desire. So, I might draw inflation next when I draw back from the Fed topic, and so forth. All right. So that's the topic modeling view of how you would actually write a Wall Street Journal article. A generative model is just thinking about the world as what is the probabilistic setup that gives me what I actually observe in the data. All right, so now once I have a view of what a topic model is, what do I do with it? You estimate it. So through estimation, you're going to recover those clusters. Really, that data set doesn't have topics built into it for you to just see. You have to figure out what the right clusters of words are, what the right topics are. And then within those topics, you have to figure out what are the words that are most probable within that topic. So it's essentially a dimension reduction of all of your text that allows you to find some lower dimensional structure in the text. All right. So people here, we're used to doing finance. I'm used to doing finance. I've done a lot of factor models in my time. One of the reasons why I like topic models a lot is because they're just factor models for text. What they really do is they boil all of this high dimensionality down to a relatively small number of things, groups of words that are typically talked about, and then describes within each of those what are the words that are most likely to be associated with those topics. All right, so it's now gaining more and more prevalence. It's a great way to summarize thematic structure in a body of text. All right, so let me show you one example in the little bit of time that I have left. So I took this Wall Street Journal data that I was referring to earlier, and I estimated a topic model on it. And I'm showing you the topics that came out that had the highest average probabilities of being drawn in a given article. All right, so here are two of essentially the top 10 topics that you see in the Wall Street Journal. The first, remember, you don't tell the algorithm what the topics are. the algorithm estimates the topics. It estimates the topics as the most probabilistic cluster of words. All right, so here is one probabilistic cluster of words. It has a high loading on Romney, Dukakis, Mitt, Rubio, caucuses, etc. And then you look at the time series patterns and the probability of this topic being drawn on any particular day or any particular month. What you see is, oh, obviously I can assign a title to this topic. It's the election topic, right? Every 4 years it peaks, and there's some interesting time series dynamics in this as well, which is over time, elections are becoming a higher and higher fraction of the overall Wall Street Journal discourse. They're somehow more economically important, right? That's how I think of it if I have a higher probability of these things over time being incorporated in the Wall Street Journal. Next, another very high prevalence topic, Gorbachev, Putin, Moscow, Russian, etc. And then we look at the time series patterns. Okay, we have essentially late 80s, early 90s, and then now. Right? This is a Russia topic. It's not surprising that we'd see this type of pattern here. These are the periods in which the news was talking a lot about what was going on in Russia. Here are some prevalent war topics that show up. So we see the first one, Iraqi, Saddam, warheads, etc. And we see peaks exactly when we would expect to see peaks associated with Iraqi conflicts. On the right-hand side, we have something that's more of like a terror Afghanistan topic. Again, peaks exactly where you'd expect, September 11th, and a gradual rise sort of, in the post-2008 era, more and more activity in Afghanistan. All right, there were some very prevalent disaster topics. So on the left-hand side, I have a financial disaster, so the subprime mortgage crisis, top words, subprime, foreclosure, countrywide, Freddie, etc. And on the right side, we actually have an interesting topic, natural disasters. Quake, Katrina, fisherman, boat, storm, earthquake. And you see that big peak associated with Katrina. All right. So I estimated a 150 topic model on the Wall Street Journal. These are the things that popped out as the most sort of important topics. They have interesting fluctuation. It's plausible. What this is telling me is that this is a nice dimension reduction that allows me to handle a million or more dimensional object. Here I was working with something closer to 2 million because I was working with these bigrams. But a million or more dimensional object reduced to time series fluctuations in 100, 150 different topics. I've compressed the dimensionality of the Wall Street Journal into something that's much more straightforward to digest. And then I wanted to reference a related paper by some friends of mine, Asaf Manella at WashU in St. Louis and Alan Moreira at Rochester University. They did something sort of related to this topic analysis that I talked about, and then they applied it to this volatility forecasting problem. And they asked, what are the topics, they didn't phrase it exactly that way, but what are the topics that are most diagnostic of high volatility episodes? And the answer is probably not too surprising. Times when people are talking a lot about the stock market happens to be times when there's a lot of volatility in the market. Times of war, volatility spikes. Times a lot of discussion about government and policy, times of high stock market uncertainty. Times when people are talking a lot about the financial sector and intermediation risk, times of high volatility. All right, so I'm going to wrap up with that example. You know, the overall theme of this paper is to just point out, obviously, digital text is a growing body of information that we could be using for the types of questions that I'm interested in on the research end, and then, of course, the types of questions that we'd be interested in practitioners in the financial industry. So modern computational tools are now making it realistically possible to use a lot of this information in a quantitative form. I've gone through some examples where I really boil it down to super simplistic representations of the text and then super simplistic analyses that I applied to that super simplistic representation. But as technology improves, we're going to be able to get much more sophisticated. We're going to be able to handle that dimensionality much more easily. So we'll be able to retain ever more of that semantic content. We won't have to boil down the data as much. And we'll have better methods developed as well for handling that. So I'll just say that this is going to accelerate. I think it's a huge growth area. It's why I've basically allocated a bunch of my current research to working on textual analysis in finance and economics. So there will only be more to come. So thanks a lot.
Thanks, Professor Kelly. My question is there any literature talking about using the text to identify expectations? For example, in your war, you can identify war, but does it will identify war will start or war will end? That kind of research has been done.
Yeah. So what I am, so essentially what you're talking about is moving from a contemporaneous prediction setting to a dynamic prediction setting, right? And the literature that I'm familiar with is actually just in the stock market setting. So in general, there's not been a whole lot of success in terms of forecasting stock market outcomes using textual analysis. There's some examples of papers that have been published. For example, Journal of Machine Learning, there was a paper that was published using some Twitter sentiment data to try and forecast, individual stock performance and so forth. I imagine if I wanted to take this to like some fundamentals prediction, I want to forecast things like earnings outcomes or, policy outcomes or war. These are, again, you're moving away from an inherently low signal-to-noise environment to a higher signal-to-noise environment. So I would expect these types of applications to be more successful there. There is one paper that I could potentially refer you to after the fact where people have used textual analysis, 10K analysis, to forecast future earnings outcomes. And you see, actually, there's quite a bit of predictability there.
Quick question about kind of about two different aspects. So in the dimensionality reduction, I'm assuming that after the fact, you go back and figure out which words that, as opposed to a priori, right? You decide what is relevant for whatever topic you want to choose. And, that makes a lot of sense. But, on a looking forward basis, how do you do that? And, I think in a lot of practitioners, myself included, have done similar type of analysis on FOMC statements. Mm-hmm. It's a very short text, highly structured, very easy to do this type of analysis. And looking backward, it tends to work. But out of sample is very difficult because the parameters are unstable, and a word that might not be relevant in one context is hyper relevant in the next. So it's very difficult to predict. So, I would just like any comments would be really helpful on how you can use these in a predictive nature, or as you said, it's not as helpful for analyzing stock returns. But do you see any helpful application on a looking forward basis? Okay, so again, I'm not surprised that if the target is a return, that you're not going to see a lot of stability here. There are a couple of other things that make FOMC kind of a hard nut to crack with things like LDA. And it's that you really don't have a lot of data. And these are, they're data-hungry algorithms. They need a lot of information fed into them to give you anything stable and informative going forward. All right, so I think there's something interesting, and you can even see this from some of the plots that I showed here. There's something interesting when you look at interpretable decomposition of what's going on in the economy, like a topic model of the Wall Street Journal, that a lot of the topics that we see are actually episodic. They're sort of one-off, all right? So if we look at a time series of stock returns, we see fluctuations. We look at time series of volatilities, peak, trough, right? But if I want to link those to the underlying economic drivers, it could be the case that, in one period it's sort of instability of the financial system. In another period, it's a one-off war or political event, and so forth, which makes the stability question, when you're trying to link market outcomes to fundamental drivers, a much harder problem. This is something I'm trying to wrestle with in my current research, but I don't think there's a great answer for it now. So essentially what I would say is that I totally agree with your assessment of how these things perform in some financial predictive settings, and I think there's a kind of a good reason about sort of the structure of the underlying news generation process in the real world that makes it an unstable problem. Lots of cool stuff to potentially be done there. Or sorry, back there.
For the text analysis, do you know if there's a way to control for the popular media bias, meaning that, people may not be talking about the most important topic. They may be talking about what's on CNN. So for instance, maybe right now there is potentially high probability of nuclear war. but people are talking what Trump tweets or what's in Hollywood or something, and so it may not show up, but then you see maybe something happening in the stock market necessarily in text.
Right. So I think that's a great question, and the way one of my co-authors, so my co-author Matt Genskow, he's a microeconomist. He's in large part a theoretical microeconomist. Now he's doing more empirical work. But his research is not about text data per se, but he got really interested in the effects of media on individual behavior. So the way he ended up getting into text analysis and becoming kind of famous for what he was doing was exactly to measure political bias in media outlets. All right, so in this setting where I'm studying the Wall Street Journal, I've effectively studied this setting because I want to think about who are the consumers of these media outlets. And if I want to get to something that's kind of what I think, something like a pure representation of the underlying macroeconomic drivers, I want the consumers to be someone that actually care mostly about the information content and would like it conveyed in a relatively unbiased way, market participants. Okay, so that's why I've specifically chosen to analyze the Wall Street Journal as opposed to, say, the New York Times or CNN transcripts or something. All right, if you're not working, and even then, of course, the bias point that you raise is relevant for the data set that I'm analyzing. I'm basically ignoring it to a first approximation, right? But if you are using data that's generated from more politically oriented media producers, then this is absolutely something you need to take into account. And now there's quite a bit of economic research that indicates, yes, this is a real issue. Yes, there are ways to actually approach it, estimate it, and account for it when you're doing some sort of economic analysis. So I'd actually point you towards Matt Genskow and Jesse Shapiro at Brown University, their work on this. Ray?
I'll just try to talk loud. Wearing your Chicago professor hat for a second, this is really interesting. You find this, but if you wanted to forecast the S&P 500 vol, you could also just say, look at yesterday's vol.
Mm-hmm.
Or a lot of the work, a lot of literature that I've seen, what you see with the Twitter feeds and all that, you can pick that up in momentum, or like I've seen some fancy machine learning algorithms where what they find is if you go long the market and the market trends, that's the findings of the algorithm. So can you suggest, in your sort of knowing the literature here, of things that might be incremental or orthogonal to what we already know, places in either like genres or papers that are different than this? Because I think we could forecast the S&P 500 vol similarly.
Okay, so this is a great question. Putting on my professor hat, I want to split it into two pieces, right? One piece is a pure statistical exercise. If I want to forecast, I know there are great forecasters of vol. Lagged vol is one of them, right? Recent signed return is another one, right? But that's not the only question I have in mind. I have an economic question, which is, why is it that there are vol shocks that occur and they're persistent, and so I can use vol to predict itself? Right? That's kind of the deeper economic question that I care about. And that's what I'm trying to get at with this research. There is obviously a way to take this and put everything that I'm doing here in a purely statistical forecasting exercise. And the natural way to set that up is you basically have competing predictors. You use the stuff that we've been using for 40 years to predict volatility. And then on top of that, you give it text-based features to load on as well. So this paper that I alluded to at the end here by Manella and Morera, they spent some time on that, and they show that there is some incremental contribution from text. It's not the kind of thing that's going to boost your volatility prediction R squared by 20%. It might boost it by 1%, right? Where you sort of think baseline monthly volatility as a 20% R squared, right? You might get up to 21%. So it is incremental in an out-of-sample sense. It's not huge. But if you want to understand the economic driver, if you want to think about interpretability as opposed to just one variable that I can't interpret predicting another variable I can't interpret, then that's where I think there's a huge bang to using text data.